Yeah, I mean, it's not like there's a shortage of things to talk about after everything that has been happening in the markets recently. But I try to pick a few charts that are relevant to the discussion that were, not only internally but also markets regarding positioning and all sorts of things that we think are relevant for this. And in this presentation, we'll start with what I think it's the most important movement happening. There's a lot of emotions in markets right now. You've got gold prices. I was just looking at it. Gold prices from December 20th went up about $340 an ounce. Today it's dropping $60. Everybody just turned bearish all of a sudden, and it's really interesting how these things change quickly. Silver, same thing. Silver was up 4.5% today, gave all everything back essentially from its performance. Now, I happen to believe we're on the verge of a very significant change in prices of most of these securities, and so I'm especially the ones that have been lagging. Miners, gold, miners, silver, and others. We'll talk about this in a minute, but this chart that you're looking on the screen is probably the most important chart right now. The DXY index, the dollar index had a bad day yesterday, has been actually constantly having a few bad days in the last few weeks, as you can see on the chart. But now we're retesting actually levels that we only saw back in 2023. Not a lot of people talking about these things. I mean, the dollar clearly is not as weak as strong as a lot of people thought it is. And it's being perceived as a very strong asset relative to other currencies, and it's not being true at all. And when you factually look at the charts or the performance of the dollar versus different currencies, this to me, it's a very meaningful break, because if you look at the positioning for most investors right now, it remains heavily on the long side. Most investors remain very long the dollar versus other currencies. You speak with most people. I remember this very well. I was in a conference in Switzerland, and I asked a question to the audience. I said, how many of you think that the Canadian dollar is going to outperform the US dollar in the next 12 months? You know how many people raised their hands? Zero. And, those are the things, those are the signs. And you look at the positioning on that as well, the CFTC positioning of how many people are speculating if the dollar is going to go up or down, the Canadian dollar. And everybody is ultra bearish on the Canadian dollar. I'm just giving you an example of one pair of currencies, but all sorts of currencies have shown similar level of positioning being offside, of which I think it will actually be, it's sort of timber for something bigger to happen in terms of the, when investors go from one side of the balance to the other side of it. And I do think we're going to see that. Let's go to the next chart. And one thing that has been remarkable is this link between the US dollar and the 10-year yield. So one is in blue, that's the 10-year yield in the US nominal terms. And then the white line is the US dollar. And what is interesting about this chart is, look, in my view, it's, if you look at the constraints from a political standpoint, especially in the US economy, you've got two things that are incredibly difficult, which is, the dollar being very strong. I mean, that basically sucks all the capital from the rest of the world, and could mean also a lot of financial tightening conditions, and of which tend to also have a lot of impact in the U.S. economy. Or on the other side is rising costs of capital, which we all know that's absolutely unsustainable given the fact where the debt is. We're currently paying, interest payments on the debt is approaching 5% now. I mean, we can't be doing this for much longer. The debt is growing exponentially just on the interest payment alone, actually causing that to happen. So if we want to reduce to levels that Scott Besson and others have been saying, that to 3% of deficit, we got to take care of that blue line that you're looking at the screen. And I'm not sure you can take care of that blue line without also causing the white line have an impact as well. I do think it's a much easier play, or a much easier, higher conviction idea to look at the real rates, given the fact that we're seeing mixed signals on inflation, particularly government data coming in very strong on that front. But to me, it seems like we're actually facing a more stagflationary environment. The picture is becoming more and more clear that stagflation is taking place here in the U.S. And I'll develop on this in a minute. Let's go to the next chart. This is just a list of currencies that have been performing well versus the dollar. So you're looking at, the Russian ruble is actually the very first one on that list. The Brazilian real is the second one in that list. It's Colombian peso, Chilean peso, and some others. And then you have on the other side, Argentinian peso, which has been doing really well over the last few years. Finally is giving some back. I don't think it's anything major there, but clearly there has been a lot of, especially I would say, South American currencies doing very well, of which I have spoken many times here in this presentations of our optimism and outlook for that region of the world. I do think that there's a lot more to happen there. It's just the beginning, in my view, and this change of the dollar is also potentially profound, potentially also the beginning of a trend of where capital starts flowing back to those regions that have been neglected for a long time. So let's go to the next chart. On the next chart, we're just stepping back and looking at the history of the US dollar cycles. I've shared this chart before, and I do think it's probably one of the most meaningful charts that at least I worked on personally of the last few years. And my view on this is that we're at the beginning of a downward trend for the US dollar, long-term downward trend, of which could have also an impact on other assets that have been benefiting from this dollar movement, particularly equity markets in the US, particularly the American exceptionalism that has been overly priced in markets already. Look at any company in the US in terms of valuations relative to other parts of the world, and you're going to see that differential being at a historical extreme. I think there's a lot of things that would actually be rebalanced to the other side. This is why I'm also not only focused on natural resources, which tend to do very well in those environments, particularly gold, which I think is leading the way, but also you can see things on the rest of the world in terms of markets that have also lagged the U.S. economy in a substantial way that I think are poised to start doing better. So let's go to the next chart. All right, well, a weaker dollar can actually have an impact on inflation. A weaker dollar can have an impact on a lot of things, but one of them is inflation expectations actually starting to rise. I mean, I've shown charts of the 10-year break. Even Kevin has shown charts of inflation expectations in the past, but nothing better than looking at actually prices of commodities that tend to be linked to those things in the real world. If commodity prices are rising, that's essentially what causes a lot of other things to rise in prices as well. So you're looking at metal prices overall have been on the rise recently, despite the decline today, and or just the fading aspect of some of these of these assets. Copper prices have been actually rising significantly. I mean, it was back in 2020 trading at around 200. It's now trading at around 500. Usually when you tend to see these breakouts, you tend to see something meaningfully higher. And I wouldn't be shocked at all if we see that. And so copper is showing a very different picture, especially regarding the stagflation things I just comment on. But I actually think it's much more reflective of what's happening with the inflationary environment that we're in still in this, with this administration. Let's go to the next chart. You can also see natural gas prices, of which today have made new 2-year highs in this chart. A little less of that, but very, very interesting. Natural gas prices are highly tied to consumer prices overall. So you want to pay attention to this. And I've said this before as well. Oil is something that has been not showing the same level of optimism, although I personally remain very bullish on oil. And I find it interesting that it is one of the few commodities that have not responded as well as other commodities. And I don't think that's sustainable either. I think we're going to see oil prices also move along with other commodities here. One of them being natural gas in this case, which is highly, highly volatile. But the trend overall since October, November has been clearly in this chart has been moving to the upside. I thought this would have something to do with AI. The natural gas seemed to be the kind of in the sweet spot of timing when it comes to the needs that we have for electricity consumption and all sorts of things. Natural gas may actually be the solution here in the near term for most of these things. A lot of people talk about nuclear, but those things are not going to be ready anytime soon. And so natural gas is your short-term solution for a lot of these electricity consumption gaps that we may see, given the fact of how much we're seeing of developments on the artificial intelligence and onshoring efforts from the Trump administration as well. Let's go to the next chart. Agricultural commodities is a very critical one. I mean, think of the amount of social unrest that we've seen historically because of food prices rising, especially in the Middle East and other places. Well, pay attention to this chart. I mean, agricultural commodities has made another decade highs, essentially. It's pretty close to a decade high in this chart. We're looking at a DBA ETF in this case, of which there's a disclosure there. The Kreskin may or may not hold positions on this ETF. But the point of this slide in general is just to show that that tends to have a very strong correlation with food prices, and food prices are likely to be impacted by the chart you're looking at the screen, and that's highly inflationary as well. Let's go to the next chart. This is a chart that looks at the equal weighted commodities index. I put on two things here. One, there is the first wave of inflation that happened in 2021. Arguably, or I wouldn't say arguably, it had a lot of factors. One of them being the pandemic itself, the response to the pandemic as well from the political side, how much the monetary pace and supply was expended at that period, the fiscal spending, the stimulus checks, and but also the whole thing had an impact on commodity prices. Hard assets has started to move in a way that we really didn't see a move like that in a very long time. And it is interesting that commodity prices are doing very similar move to that first wave of inflation that we saw back in 2021. Are we about to see a surge in prices? Oh, look, gold prices is sort of a leading indicator. It tends to be a leading indicator for commodities. So if that's the case, if you look at a price of gold, of which I'll show it in a minute, it's going vertical. So is it possible to see this chart going vertical as well? It wouldn't shock me at all. History is there for us to use it as a potential roadmap to understand what could likely happen here in the near future. So let's go to the next chart. This is also inflationary. Now let's talk about the stag side of the stagflation, of which we've had a few reports recently. I'm going to show two charts that I think are relevant. One of them is the one from today, which I think it's wow. I mean, it was down 0.9%. You annualize this number, we just had a 10% decline on retail sales. I mean, think about it. This is a pretty significant number. It's a very large drop in retail sales, the largest drop since March of 2023. At the same time as inflation is going the other way, and so this is quite significant because this also in nominal terms. If you look at it in real terms, the decline is even worse. So I'm not sure a lot of people are talking about this, but there's a clear divergence of economic activity actually waning while inflation has been on the rise. Now let's talk about another chart that I think it's part of this as well. On the next one. On the next one, now you're looking at what I think it's, and I'm sure Kevin would agree 100% with this, but you're looking at one of the biggest disconnects of fundamentals that we've probably seen in history, but also near term. When you look at what's been happening with, look, markets tend to move ahead of things, and what we tend to see usually is if markets are going up, it tends to have an impact on what estimates have been regarding earnings or earnings per share of most companies in the index. What is interesting, however, is that more recently, and you can zoom out on this chart, and you're going to see there's a very strong correlation between the white line and the red line throughout history. Now, recently, we're seeing a divergence between these two things. And so analysts and other folks are starting to change their estimates for earnings for most of these companies that are part of the NASDAQ 100, causing the estimates to actually fall quite significantly. It's now down about 10.4% as the prices of these shares of these companies are actually at all-time highs. And so keep in mind, the 10%, the 10.4% decline in estimates of earnings per share is not accounting the fact that we also, I mean, this is all nominal, right? So inflation, it should be playing a role here, and it's also inflating the red line, believe it or not. Although the red line is falling, it is inflating the red line, and so it has an impact of squeezing the margins of companies. So if you have stagflation, which is one of the worst combinations of an economic environment you can find, that is quite relevant what we're seeing here. Let's go to the next chart. I'm going to pick up here because I gotta go quick. Gold prices have been on a surge. Today we've seen a small decline, or not small. $60 is not a small decline, but no, nothing changes the thesis. I do think this is one of the most bullish environments I've seen in my career, at least for metals, and I'm talking about long term. And what makes me think about is the other derivatives of the gold trade or the gold idea that are yet to play out, in my view. Let's go to the next chart. So next chart, you're seeing the production margin of most of the mining companies. A lot of people have this view that mining companies never make any money. And so I wanted to put this chart together. The all-in sustaining costs for mining companies is at about $1,450. Right now, this is a median calculation of the top 50 miners by market cap across the Canadian and US exchanges. And in this model, I basically look at the median of the all sustaining costs, and now I'm looking at relative to gold prices. And you can see they're all on the same axis, just to show you the gap between the two. The gap means the margin of these companies. Now, keep in mind, all sustaining costs is more of an operating cost type of calculation. You don't have a lot of the things that usually you have in terms of CapEx to run a mine. That's another add to the calculation here, but not a part of the production margin that is supposedly what we're focused on here. And so it is remarkable to me that this is likely to create one of the best setups for the miners in terms of surprising on the upside when it comes to fundamentals that I've seen in my career as well. Let's go to the next chart. Gold miners' cash flow per share has been on the rise. I showed this chart last week, and it's just another way of showing what I showed in the past chart, but now including mostly, it's just a cash flow. It's not including CapEx again, but you can see here that it is at its highest levels in 13 years, and I think there's ways to go here. We're just getting started on what miners can actually do in terms of profitability. And, that's why we're so bullish. I mean, this is yet to reflect on shares. And I think that some of the companies that have reported recently are just a first glimpse of that. And we're yet to see a lot more companies actually surprising on the upside, in my view. Let's go to the next chart. Next chart is the gold to oil ratio, which is a clear also picture of that. I was actually showing this chart. I'll give it credit to Kevin. I was showing this chart because I wanted to see how cheap oil is relative to gold. Number one. Number two is the second highest gold to oil ratio we've seen in history. When you exclude the craziness that we saw during the pandemic. But I want to show this chart. Kevin's like, well, that's the margins of the miners. It's like, yes, that's it, man. That's a lot of the open pit projects that are heavily impacted by energy prices. That's your picture right here. Of most of these companies are enjoying the fact that oil prices are low relative to metal prices, and so their cost structure is been it's all-time highs. I'm not saying it's not. It is at all-time highs, but it's substantially lower than where gold prices are. And that's the part. It's that gap that I think it's so important, especially for companies. Let's go to the next chart. Finally, we're looking at the total assets under management. This has been a very different gold environment that we've seen in the past. The rush that we're seeing in terms of a demand is coming not from Eastern societies only. It's certainly coming from there, from BRICS, from China, from Russia, but it's also coming from Western societies too. And the chart here, that's what it's showing. It's just looking at the AUM. A lot of people say, oh, look at the ounces and all that. I get that. I'm only focused on the capital coming into the vehicle. That's all. I'm not asking if there's gold in the vehicle or not. That's not the point of this. That's not the point at all. Everybody that made that comment, that's not the goal of this chart. The goal of this chart is showing how much capital is coming into this vehicle, how many investors are putting capital into something that is linked to gold prices. That's finally we're seeing the catch up of this of this ETF when it comes to attracting capital, and that's Western capital in my view. And this is why this time has been different. What we're seeing, I hate to use that word, but the expression, but we're seeing a much more combined demand coming from different parts of the world relative to what we saw in the past year. Let's go to the next chart. Almost done. If you think about gold, the derivative of gold, the high beta version of gold, that is emerging markets too. It's not only the miners, it's emerging markets. We're seeing a big surge in gold prices. If you look at historically, emerging markets, in my view, are about to show their strength as well. If we cap if we cap yields and we cap the dollar, the blue line tends to do very well. I think we're on the verge of seeing more of that, not less, more. And so I'm really focused on this as well. Let's go to the next one. And lastly, despite the fact that we had this fading action in the markets today for silver, look, I've been following silver. This is my last chart. I've been following silver for a long time. And I'm just going to say one thing. If there are times when I've been following silver that I really think they're very meaningful, that you want to be, you want to be paying close attention to what's likely to happen here. And in my view, we're one of those moments. Gold prices have already gone up. Everybody is skeptical about silver, especially after today. And that's when the metal tends to like it. And I am extremely bullish. I think we can easily see a move to, retesting the levels of $40 an ounce there that we had there. I do think we're going to see a higher price levels. This is why I'm so bullish on silver and think it's, in my view, the most undervalued metal on the planet. But I also think that that's the first step. It's retesting those highs. And I think we're about to see a big candle there. It's just my views. It certainly is very timely what we're seeing in terms of action in silver prices, in my view.